calculated on the basis of incomes earned by him during the relevant previous year under different heads of incomes. Number one, income from salary. Then number two, income from house property. Three, income from business or profession. Then four, capital gains. And finally, number five, income from other sources. After having discussed all the details of calculation or computation regarding taxable income of an SSC, we shall also try to give our special attention towards the computation of taxable income from an SSC. As far as most of us have been employed in the government sector or in the private sector, therefore the question of calculation of taxable salary income assumes considerable significance for all of us, being treated as SSCs under the provisions of the Income Tax Act. Now, then we shall go over to discuss a new concept known as alternative tax system. This alternative tax system has been introduced by the Government of India in recent years. Under this alternative tax system, the SSC is able to pay the amount of taxes on the basis of certain lower rates of tax, in fact, but at the same time, the SSC is actually deprived of certain important exemptions and deductions which are available under the old scheme or the prevailing system of taxation. I mean, since both the systems are available to the SSC, the SSC is supposed to calculate the amount of taxability, tax liability under both the schemes, and finally he has to go for the one or choose the one which is actually financially beneficial to him in terms of reduced income tax liability. Now, before we begin our discussion of the relevant income tax provisions under the Income Tax Act 1961, first of all, I would like to explain to you the basic meaning of an SSC. Then we shall try to understand certain other basic concepts also, such as the meaning of a previous year, then the meaning of an assessment year, and subsequently we shall try to draw a proper distinction between the two concepts. As far as the meaning of an SSC is concerned, an SSC is actually a taxpayer who is supposed to pay certain amount of taxes, interest, penalty, etc. To the Government of India or to the income tax authorities under the provisions of the Income Tax Act 1961. According to the income tax provisions, there are 7 different categories of SSCs, including individual SSCs, Hindu undivided family, partnership firm, company, form of organization, then association of persons or body of individuals, local authority, and artificial juridical person. These are all different categories of assessors who have been defined under the provisions of the Income Tax Act 1961. But our present discussion will be mostly restricted to the computation of taxable income and tax liability of an individual SSC or a Hindu undivided family or an association of persons or body of individuals. Next, before going into our real discussion, I would also like to explain to you the meaning of a previous year and also the meaning of an assessment year. These two concepts are actually the basic ones. As per the meaning of a previous year is nothing but a financial year starting on 1st of April and ending on 31st March the next year. In fact, income of a previous year is made taxable or made chargeable to tax during the next financial year, also known as the assessment year. For example, suppose we take 2022 and 23 as the relevant assessment year, then naturally the relevant previous year in this case will be the preceding year, that is 2021 and 22. And again, if 2022 and 23 is considered the previous year, then naturally the next year or the following year will be known as the assessment year, that is 2023 and 24. Therefore, here we can see that a particular previous year, a particular financial year has a double role to play, in the sense that it can be treated both as a previous year and also as an assessment year. Now, in addition to all the in addition to the meaning of all these important basic concepts already explained to you, I would like to say that normally income of a previous year is made taxable during the next assessment year, or during the next financial year. Now, for example, all incomes earned by an SSC under relevant heads of incomes during the previous year 2021 and 22 will be made chargeable to tax during the next financial year, that is the assessment year 2022 and 23. Now, this is actually the normal rule of taxation of individual incomes or incomes earned by different categories of SSCs. But there are 5 exceptional cases where income of the previous year will be made taxable not during the not during the assessment year, but it will be made chargeable to tax during the same previous year. These provisions have been specifically provided for so that the concerned SSA would not be in a position to resort to any kind of tax malpractice or evasion of taxes. Now, next, I would like to talk a little bit about income tax rates also. As far as income tax rates are concerned, such rates are actually fixed by the Finance Act of each and every year, which are duly passed by the Parliament, along with budgetary provisions or provisions for the annual budget. I mean, now the Finance Act actually specifies the income tax rates which are applicable for the current previous year, and also for the next previous year. For example, the current assessment year may be taken as 2022 and 23. Naturally, the current income tax rates or rates applicable for this current assessment year 2022 and 23 will be specified under the Finance Act, and at the same time, the advanced tax rates which are applicable for the next assessment year 2020 through 2023 and 24 will also be specified. These are some of the basic aspects of income tax provisions in India. Now, after having discussed all such basic concepts or fundamental concepts relating to income tax provisions, we shall now proceed to discuss our PPT presentation. I hope the PPT is visible to all the participants. Let me know.
Yes, sir, we can see it.
Okay. Thank you. Well, thank you very much, Bhavna ji, and all the different members of the organizing team. In this connection, I would like to say one thing. You say, first of all, I'm thankful to all members of the organizing team of Social Research Foundation who are taking a special interest to conduct such lecture programs or PPT presentations and so on certain socially relevant themes. From my side, I would like to say that since we belong to the faculty of the university, we are basically trying to reach out to the broader society. So you can call it as a kind of social outreach program, you say, by which we just do not want to remain confined to the classroom teaching research. We also want to go beyond classes and reach out to the common people as far as discussion or understanding of certain socially relevant issues are concerned. I mean, against this background, I would like to start my discussion on the relevant topic for today's discussion, that is income tax provisions in India, part 1. In the first place, we shall try to understand exactly how the taxable income of an SSC is actually calculated according to the relevant provisions of income tax law. While calculating the taxable income of an SSC, we are supposed to consider all incomes earned by the SSC during the relevant previous year. Suppose, for example, 2021 and 22. Now, during 2021 and 22, various kinds of incomes may have been earned by a particular individual assessee. In the first place, we have what is known as income from salary. Most of us actually belong to the government sector or to the private sector, and we are rendering our services to our employer, in lieu of which a certain amount of salary income is actually received by us, or it is paid by our employer to us. As far as income from salary is concerned, the details of calculation of taxable income from salary will be explained after some time. Then comes income from house property. Our SSC may happen to be the owner of certain house properties, from which he might be receiving certain amount of rental income during the previous year. Now, this is actually the simple meaning of income from house property, which is normally equated with rental income. But as far as the scope of income tax provisions is concerned, the amount of taxable income from salary, the amount of taxable income from house property is to be calculated not only with regard to let out houses, but also with regard to those houses which are actually self-occupied by the owner himself for his own residential purposes. Therefore, under the provisions of the Income Tax Act, the scope and meaning of income from house property is something much broader, you see, and we shall be discussing a little bit about the computation of taxable income from house property also. The third important head of income is known as income from business or profession. Normally, our SSC might be running some kind of business or profession. Therefore, the amount of income arising from such business or profession will be taken into consideration, and this will be added as a part of his gross total income during the relevant previous year. Next important head of income is known as capital gains. The capital gain is actually nothing but the excess of sale price over the cost of a particular capital asset. For example, furniture, buildings, tools and equipments, machineries, and so on. These are different examples of capital assets. Whenever a sale of a particular capital asset is taking place, then naturally some amount of profit will be accruing to the SSC, or some amount of loss may be sustained by the SSC. This is actually a very, very simplistic meaning of capital gains. But according to the provisions of the Income Tax Act, there are numerous provisions, rules, and regulations which are to be applied in the computation of taxable capital gains. In fact, this topic is one of the most difficult topics to understand, but we shall try to discuss as far as possible on this aspect of taxable capital gain earned by an SSC during the relevant previous year. Next comes income from other sources. This is actually the last head of income, but this should not be considered the least one, because there may be certain incomes, such as incomes of a director received in the form of fees for attending various board meetings. Then maybe some amount of rental income may be received by the SSA from the letting of a vacant piece of land, isn't it? Then maybe our SSA has deposited a certain amount with a bank, you see. Naturally, a certain amount of interest income will be generated thereon, and this amount of interest income will be accruing to the SSA during the relevant previous year. These are all different examples of incomes which cannot be classified as belonging to any of the preceding four heads of incomes, such as income from salary, house property, business or profession, and capital gains. Therefore, all such incomes are to be treated as residual incomes or surplus incomes, and these are to be made taxable under the last head of income, known as income from other sources. Now after finding the sum total of all these five different heads of incomes, then we are supposed to make certain adjustments by way of set off and carry forward of losses. As per the meaning of set off of losses is actually nothing but the adjustments which we are supposed to make under both intra-head adjustment and inter-head adjustment during the same previous year. As far as intra-head adjustment of losses is concerned, that suppose our SSC happens to be the owner of 2, 3, or 4 houses. The amount of loss arising from a particular house, that may be adjusted against the income arising from another house. This is actually known as adjustment of loss arising from a particular source of income against income arising from another source of income falling under the same head of income. So, similarly, loss arising from a particular business may be adjusted against the amount of profit or gain arising from another business. These are different examples of adjustment of losses in the form of intra-head adjustment made during the same previous year. In addition to this, there is also another concept known as inter-head adjustment of incomes. You see, here the loss arising under a particular head of income may be adjusted against the amount of income or profit arising under another head of income. But for example, the business loss may be adjusted against income from other sources, or against capital gains, or against salary incomes, and so on. So both intra-head adjustment of losses and intra-head adjustment of losses, both these kinds of adjustments of losses are to be carried out during the same previous year, and this is exactly what is referred to as setup of losses. Now as against setup of losses, there is another concept known as carry forward of losses. Suppose after making all possible adjustments under intra-head adjustment and intra-head adjustment of losses during the same previous year, there is still some amount of loss which could not be fully adjusted during the same previous year. Then naturally such unadjusted loss of a particular year will be carried forward to be adjusted against the incomes of the future previous years. After making such adjustment of losses in the form of both setup of losses and carry forward of losses, and then we shall be making certain deductions which are permissible under sections 80C to 80U, and so that the balance amount that remains will be treated as the SSC's taxable income or taxable income. Therefore, on a summary note, we can say that the amount of taxable income or total income or net income of an SSC is to be calculated on the basis of incomes earned by him under the relevant heads of incomes, maximum under 5 different heads of incomes during the same previous year. Now, the next important slide talks about how the taxable salary income of an SSC is to be calculated. As far as the computation of gross salary income of an SSC is concerned, this amount actually comprises of 3 different components. Number one, basic salary, including arrears and advance or basic items of salary. Then number 2, profits in lieu of salary. Then taxable allowances, and then taxable perquisites. The sum total of all these different components would be known as gross salary income of the SSC. As far as basic items of salary are concerned, such amounts actually include basic salary or wages earned by the SSC during the relevant previous year. Then maybe certain amount of arrears or advance of salary have also been received by the SSC during the same previous year. Then there may be certain taxable portions of pension, gratuity, leave salary, and so on. All these different items of salary are known as basic items of salary. Next comes profits in lieu of salary. But let me just give an example in this connection. Suppose an employee is going to take voluntary retirement from services. Then naturally in this case, a certain amount of monetary compensation in the form of lump sum payment will be made by his employer to the concerned SSC. This amount actually we call as profit in lieu of salary, because here the source of income stops altogether, and instead of this, the employee is going to receive certain amount of lump sum payment from his employer. Therefore, this is known as profits in lieu of salary, where the employee will not be in a position to receive any amount of salary income on a regular or continuous basis. Rather, certain amount of monetary compensation will be paid to him in lump sum form by his employer. Here also, the taxable portion of such profits in lieu of salary is to be calculated, and this is to be added as a part of the employee's gross salary income. Next comes taxable allowances. There are so many allowances you see: house rent allowance, transport allowance, commutation allowance, deputation allowance. Then so many other allowances. All such allowances have been broadly divided into three different categories. For example, there are certain allowances which are to be treated as fully taxable. Then in the second place, there are certain other allowances which are to be treated as partly taxable and partly exempted from tax. Then there are still other allowances which are to be treated as completely exempted from tax. Now, therefore, in any case, the taxable portions of various allowances are to be taken into consideration and added as a part of gross salary income of the SSC. Next comes taxable perquisites. As far as the meaning of taxable perquisites is concerned, the meaning of perquisites is actually very much known to all of us. The perquisites actually refer to certain facilities or amenities which are granted by the employer to his employee during the previous year. For example, housing facility, then motor car facility, credit card facility, club facility, and so on. Since all such amenities or facilities are being provided by the employer to his employee during the previous year, the taxable portions of such perquisites is to be calculated by applying the relevant provisions of income tax law, and this is also to be added as another important component of taxable salary income of the SSC. And then the sum total of all these important components of salary incomes is exactly what is known as gross salary income. And then from the amount of gross salary income of the SSC so calculated, we are supposed to make certain permissible deductions under Section 16. The first one is standard deduction. Next one is entertainment allowance deduction. Next is employment tax or profession tax paid by the SSC during the previous year. So as far as the amount of standard deduction is concerned, such standard deduction can be allowed up to rupees 50,000 during the relevant previous year. This standard deduction is provided to the SSC so that he would be in a position to meet necessary expenses incurred in the performance of its duties. As far as entertainment allowance is concerned, such amount of allowance is first of all added as a part of gross salary income of the SSC, and subsequently entertainment allowance deduction is granted only to an employee who happens to be a government sector employee. As far as the amount of exemption on entertainment allowance is concerned, you see, such entertainment allowance deduction is actually taken as the lowest of three different amounts. Number one, actual amount of such entertainment allowance received by the SSC during the previous year. Then number two, 20% of his basic salary. And then number three, rupees 5,000. Out of these three different amounts, the lowest one will be treated as the amount of entertainment allowance deduction, and this will be deducted under Section 16. Next comes employment tax or professional tax paid by the SSC during the previous year. In case such amount of tax has been paid by the SSC during the previous year, then naturally it will be allowed the deduction under Section 16. But where such amount of tax has been paid by the employer on behalf of his employee, then first of all, this will be added as a part of gross salary income of the SSC, and subsequently the same amount will be allowed the deduction under Section 16. After having made such deductions under Section 16, the net balance that remains, that would be treated as the SSC's taxable income from salary. Now, the next slide actually talks about the computation of tax liability of an SSC. Since the amount of taxable income of an SSC has already been calculated by applying the relevant provisions of Income Tax Act, then next we shall try to find out the amount of tax which is actually payable by the SSC on the basis of his actual taxable income or total income or net income. Now, for calculating the amount of tax payable by the SSC, we are supposed to apply the relevant rates of income tax which are applicable for the relevant assessment year. Now, for the assessment year 2022 and 23, naturally the rates of income tax have already been prescribed, you see, by applying the relevant rates of income tax to the amount of taxable income of the SSC. We shall be in a position to calculate the amount of tax on net income. Then from the amount of tax calculated on net income, we are supposed to deduct the amount of rebate under Section 87A. as far as the amount of rebate under the section is concerned, such amount of rebate is normally granted to a resident individual who is having taxable income maximum up to rupees 5 lakh and not beyond that. In this case, the maximum amount of rebate permissible under section 87A, that amount can actually go up to rupees 12,500. Then after this, the amount of surcharge is also to be added. In fact, different rates of surcharge have been prescribed for different levels of taxable incomes earned by an SSE during the relevant previous year. If the SSE's taxable income is not exceeding rupees 50 lakh, then naturally the amount of surcharge is to be taken is nil. Then in case the taxable income is exceeding rupees 5 lakh, but it is not exceeding, but it is up to rupees 1 crore, then the rate of surcharge is to be taken as 10%. Then where the taxable income is exceeding rupees 1 crore, but it goes up to rupees 2 crore and not beyond that, the rate of surcharge will be taken as 20, 15%. Then where it is exceeding rupees 2 crore but not 5 crore, the relevant rate of surcharge will be taken as 25%. And finally, where the SSC total income or taxable income is exceeding rupees 5 crore, then naturally the rate of surcharge will be taken as maximum, that is 37%. So to summarize the surcharge rates once again, there are actually 5 different rates of surcharge. Initial rate is actually nil when the SSC's total income or taxable income is not exceeding rupees 50 lakh. And then the next rates are 10%, 15%, then 25%, and 37%. By applying these different rates of surcharge, we shall calculate the amount of surcharge to be added, you see. And after this, there is also another thing known as health and education cess, which is always added at the rate of 4% to the amount of tax so calculated, and also to the amount of surcharge so added at the rate of 4%. Here it's very important to note that health and education cess is always added at the rate of 4%, irrespective of the levels of taxable income of the SSC. That means the amount of taxable income earned by the SSC may be low or high, but in all possible cases, and in the case of all kinds of SSCs, the amount of health and education cess is always to be added at the rate of 4%. Now, after calculating such a total amount of tax, then we are supposed to make a deduction of certain prepaid taxes. Number one, tax paid on self-assessment. Then number two, advance tax paid during the previous year. Then number two, tax deducted at source during the previous year. As far as advance tax paid is concerned, you say, such liability to pay advance tax actually arises in a situation where naturally such amount of tax will be adjusted against the tax liability of the next year. I mean, as I mentioned some time ago, even the advance tax rates are prescribed or decided as a part of the Finance Act itself during the current assessment year, along with the current year's income tax rates. Then advance tax paid will be allowed the deduction, and similarly tax deducted at source will be allowed as another deduction. You see, as far as TDS is concerned, here the amount of tax is to be deducted by the employer right at the source of income itself. That means, for example, I'm working as an employee of Delhi University or Shivaji College, you see, which happens to be my employer. Then naturally from the amount of my monthly salary, certain amount of tax will be deducted by my employer or Shivaji College itself in the form of what is known as tax deducted at source. So tax is always deducted be on during the relevant previous year, relevant to the relevant assessment year. So by applying all these income tax procedures, the amount of tax liability of an SSA is to be calculated. Since the amount of tax liability of an SSA is to be calculated by applying the relevant rates of income tax, In this connection, we shall try to discuss exactly what rates of income tax are applicable in the case of different categories of individual assessees. In the first category, we have all resident individuals who are still less than 60 years of age. Then in the second category, we are having resident senior citizens, rupees 3 lakh of taxable income. For the second category of senior citizens who have already reached the age of 60 years or more, the initial amount of exemption will be given up to taxable income of rupees 3 lakh. Then for rupees 3 lakh to rupees 5 lakh, the relevant rate of income tax is 5%. Then for rupees 5 lakh to rupees 10 lakh, the relevant rate is 20%. Then for taxable income exceeding rupees 10 lakh, the rate is to be taken as 30%. Now, for the third category of resident super senior citizens who have already attained the age of 80 years or more, up to rupees 5 lakh of income, it will be treated as fully exempted from tax. Or in other words, the amount of tax will be taken as nil. Then for taxable income of rupees 5 lakh and more, but up to rupees 10 lakh, the relevant rate of tax will be taken as 20%. And then for income exceeding rupees 10 lakh, the relevant rate will be taken as 30%. Therefore, we can see that most of the income tax rates for different income tax slabs are actually remaining the same across different categories of individual assessees, except that the initial amount of exemption is actually rupees 2,50,000 in the first case, then it is rupees 3 lakh in the second case, and finally it is rupees 5 lakh in the third case. Next, different rates of surcharge on income tax are also given. You see, after the amount of tax has been calculated and the amount of surcharge has been added. You see, in this connection, these points have already been explained to all of you. For taxable income up to rupees 5 lakh, the amount of surcharge is to be taken as nil. Then for taxable income falling between rupees 5 lakh and rupees 1 crore, the relevant rate is actually 10%. Then between rupees 1 crore and rupees 2 crore, the rate is 15%. Then between rupees 2 crore and rupees 5 crore, the rate is 25%. Then for taxable income exceeding the level of rupees 5 crore, the rate is to be taken as 37%. After having added the amount of surcharge so calculated, then we shall proceed to add another amount also known as health and education cess at the rate of 4%. Here it's very important to remember that health and education cess is always added at the rate of 4% of the amount of tax calculated, and also the amount of surcharge added to that. This health and education cess is always to be included or added at the rate of 4% in the case of all kinds of assessees, irrespective of their taxable income levels or levels of taxable incomes. So, after having discussed some of the basic concepts under the provisions of the Income Tax Act 1961, then we proceeded to discuss exactly how the taxable income of an assessee is to be calculated, then how the tax liability of an assessee is to be calculated, then how the amount of surcharge is to be added, how the amount of health and education cess is to be added, isn't it? So, all these different income tax procedures are actually prevailing under the existing scheme of taxation. But during the last during the last few years, in fact, a new system of taxation known as alternative tax regime has been introduced by the government of India under section 115 BAC. This scheme is actually known as the alternative tax regime under section 115 BSA. This new system of taxation has been introduced by the government of India only during the last few years. And for the assessment years 2021 and 22, and for the and 2022 and 23, all taxable incomes earned by an assessee during the relevant previous year up to the limit of rupees 2,50,000, this amount of taxable income will be treated as fully exempted from tax. Then between rupees 2,50,000 and rupees 5 lakh, the rate is actually 5%. Then for income of rupees 5 lakh to rupees 7 lakh and 50,000, the relevant rate is 10%. Then for rupees 7 lakh 50,000 to rupees 10 lakh, the rate is 15%. Then between rupees 10 lakh and rupees 12.5 lakh, the relevant rate is 20%. Then between rupees 12.5 lakh to rupees 15 lakh, the rate is 25%. And finally, for taxable income exceeding the level of rupees 15 lakh, the final rate of income tax is given as 30%. So here also the slab rates of income tax are actually being followed, you see, with increase in successive levels of taxable income of the SSC, the rate of tax also goes on increasing, because in India we are actually following what is known as the progressive system of taxation of incomes. That means higher the level of income, naturally the amount of tax liability of the SSC will also be correspondingly higher. Higher the level of income, higher would be the amount of taxes payable with the SSC, and similarly, lower the amount of taxable income of the SSC, lower would be the amount of tax liability of the concerned SSC. I mean, so here also under the alternative tax regime, there are so many different rates of income tax which are comparatively lower than the amount of income tax rates which are applicable under the existing or the prevailing system of taxation. But here it should also be noted that even though the SS is able to avail of lower rates of income tax under the alternative tax regime, he is actually deprived of so many important exemptions and deductions which are available under the existing or the old scheme of taxation. I mean, in fact, the government is giving both options of taxation of incomes to the individual SSC concerned, and finally it is up to the individual concerned to calculate his tax liability under both the schemes of taxation. And finally, he has to opt for the one or choose the one which actually results in more of tax savings to him, or which proves to be more financially beneficial to him in terms of reduced income tax liability. Now, as far as the alternative tax regime is concerned, you say this alternative tax regime is actually available only for an individual SSC or a Hindu undivided family. Then in the second place, this scheme is actually optional for the SSC to choose alternative tax regime. I mean, that means there is no compulsion from the government as such for the SSC to choose any system of taxation, either the old one or the new one known as the alternative tax regime. It is optional for the SSC to choose alternative tax regime, which he may or may not decide to choose. Now, then in the third place, total income of an SSC is calculated under alternative tax regime without claiming certain exemptions and deductions, such as exemption on house rent allowance, exemption on leave travel allowance, then standard deduction of interest on house loan in the case of two self-occupied houses, then deductions under sections 80C to 80O, except deduction of employer's contribution towards the national pension scheme under section 80CCD subsection 2, then deduction under section 80 double J double A, and then deduction under section 80 LA. You see, all such important deductions and exemptions will be covered in our subsequent discussion or lecture on the same topic, you see, which we shall try to take up some other time, because for the timing we are actually limiting our discussion to our understanding of certain basic concepts like computation of tax liability, then different rates of income tax applicable under both the schemes of taxation, like the old one or the existing one, and the alternative tax regime, and so on. Now, here, a sample of form number 16 has also been displayed on the screen itself. This form number 16 has been issued by my employer, which happens to be Shivaji College, for a constituent college of Delhi University. You see here, my gross sale income has been mentioned as rupees 32 lakh 30,760. Then standard deduction has been allowed to me to the extent of rupees 50,000. You can see it, I mean. Then after this, income chargeable under the head salary has been calculated as rupees 31,80,760. Then actually I have reported certain rental incomes from house property which are being owned by myself during the relevant previous year, and this amount of rental income is stated as 2,75,520. Then my gross total income has been calculated as this amount you see, and then deduction under section 80C that has been provided to the extent of rupees 1,50,000. Since this deduction known as deduction under section 80C is very important to each and every SSA. I would like to explain this particular deduction a little bit. As far as section 80C is concerned, the SSA may be making certain eligible savings or investments during the previous year. For example, he may purchase national saving certificates. He may be paying certain amount of life insurance premium. He may be paying for his children's tuition fees. Then he may be contributing certain amount towards the provident fund scheme and so on. All such eligible savings or investments are to be allowed as a deduction under section 80C, but subject to a maximum limit of rupees 1,50,000. Since I'm contributing certain amount towards my general provident fund, and also I am subscribing to an insurance policy for which I'm paying certain amount of insurance premium also. Here the maximum deduction that has been granted to me under section 80C is given as rupees 1,50,000. Then deduction in respect of health insurance premium under section 80D. This section is also very important because in the present times to avail the medical facility is quite a costly process, you see. And therefore, it is always advisable for the SSC to go for some kind of a health insurance scheme under section 80D. Here, here the maximum deduction that can be granted to a normal SSC is actually rupees 25,000. But in the case of a senior citizen, it can go up to rupees 50,000 per annum also. So here, deduction under section 80D has been granted to me to the extent of rupees 12,000. So finally, my all aggregate of deductions is calculated as rupees 1,68,861, and finally the amount of taxable income earned by me during the relevant previous year, that amount is actually calculated as rupees 32,87,419. Now the amount of tax calculated on such taxable income earned by myself, that amount has been stated here. Then health and since this amount of taxable income is not exceeding the level of rupees 50 lakh, then naturally the amount of surcharge payable by me, that is to be taken as nil. But health and education says is always added at the rate of 4%, you see. So here the amount comes to rupees 31,949, and finally the amount of tax payable by me, or the net tax payable by me, that amount has been calculated as rupees 83 lakhs 88 lakh 30,675. Now next all of you can see the income tax return which has been generated with respect to form 16 issued by my employer and submitted by myself to the income tax authorities. So here again my taxable income has been stated. Then net tax payable by me has been calculated. Then taxes already paid have also been stated, you see. Since the amount of tax paid by me happens to be more, you see, in the form of tax deducted at source by my employer, being Shivaji College itself. In fact, the college has deducted more of taxes than what is actually due to be paid by myself to the income tax authorities. Therefore, this amount of excess tax already paid by me to the income tax department, then this amount is to be claimed by myself as refund of income. Normally, such amount of refund of tax generally comes back to the SSA after some time period, you see. And this is a normal tax practice of the income tax authorities. So here the final amount or the net amount of tax payable by me is actually negative, that is minus 8,839. So since I have paid a little more of taxes, you see, as compared to the amount of tax which is actually payable by me on the basis of his taxable income, this amount of income tax refund I can certainly claim from the income tax department. So these are all different aspects or fundamental aspects of income tax law and practice, you see. system, which I've been explaining to all of you. Hope I've been able to do some minimum justice to the subject. The subject of income tax is actually a complicated one, but summarizing all the important provisions just within one lecture session, this actually proves to be a Herculean task. But even then, some efforts have been made by me to explain some of the basic concepts, and also some bit of understanding about the computation of taxable income as well as tax liability of an individual SSC. But in our next discussion, we shall try to cover some of the important deductions or exemptions which are normally granted to an SSC, or which can be availed by an SSC under the provisions of the Income Tax Act. So with this, I think it is time for me to conclude my discussion, you say. In case there is any kind of query or questioning, you say, I shall be so happy to answer. Bhavna ji,
Yes,
so
sir.
I think it has been slightly less than 1 hour, but with this limited time, you see, we have tried to cover as much as possible as far as the provisions of Income Tax Act 1961 are concerned. I mean, so in case there is anything to be asked, you see, or any doubts are to be clarified, then I shall be so happy to answer. I mean, in case there are such questions.
So I think no participant have any question from their side. So
Okay,
I think
okay.
we should conclude or wind up this session. If anyone have any question, he can send us the questions on YouTube session. We will upload this
Uh,
video on YouTube link, and if anyone have any questions, he can ask over there. So you can
uh,
also
that, that,
answer from there. Okay.
that is
We
that
will
is actually
also
so nice of you. So nice of you, Bhavna ji, and other members of the organizing team, since you are making such sustainable efforts, you seem, to promote academics. Because here we are basically trying to focus on certain socially relevant themes or issues which are affecting all people across different sections of the society. Last time, actually, we discussed something about stress management, you seem. This time, we have focused on some of the important income tax provisions
income
which are
tax.
applicable kinds of
Yes.
SSCs. Then in the next session, probably we can take up the portion relating to deductions and exemptions available under the Income Tax Act 1961. This is actually a healthy kind of a social outreach program, you say, which is being undertaken by Social Research
Definitely.
Foundation.
Definitely,
I'm
definitely, sir. We will also
I'm
wait for your next session, and you can again fill up the form whenever you have completed. Okay. Whenever you have time,
thank
you
you so
can. Thank you, sir, for giving such a nice presentation on the very relevant topic, which is related to income tax. And we will also wait for your next session. Okay.
so nice of you. I feel so much encouraged also. But we basically should try to do something which is positive for the broader society. I mean, this is the motto,
Yes, yes,
final
yes.
motto. I mean,
We will also
thank you,
contribute for answer. Okay. Thank you, sir.
thank you. So nice of
Thank
you.
you, sir.
Thank you again. I mean,
Thank
okay.
you.
Subscribe now and press the bell icon. Never miss an update.